Hello and welcome back to the Wealth Whisperer. Today I'm going to be sharing with you how making just one small tweak or making one small decision could change your finances forever. It could have a massive impact in the long term. And what we're talking about here today is using the power of time along with your money to create a small fortune over the course of that time. So I'm going to be sharing with you some real world examples of what I'm talking about, personal ones and ones that I've heard about with other people. And it's going to hopefully open your eyes up to the idea of what sort of a little decision could you make right now to have that huge impact in your financial future. So let's get going. The first idea, very simple really, the first basic idea is if you have a significant amount of money sitting in a bank account, let's say, that you would look around and see if there's anywhere else that you could put that money that would make you more money, i.e. a better interest rate. So I had a client not so long ago who had not such an insignificant amount of money, several tens of thousands of pounds sitting in a bank account. And I was having a chat with her and basically saying, well, that money is basically fairly redundant. It was earning less than 2% a month. And so she started to research about what other banks were out there and what interest rates there were, etc., etc. And she decided to move it into a higher interest rate account. And I think it was earning around about 5.5%. So still very safe. And she moved that money from the lower rate account into the higher rate account. And as a result of doing that, the net difference per year was £4,700 extra money from the higher rate of interest compared to where she had had it for over 5 years. She'd just been too scared to know what to do, how to move it, where was the safest place to move it, etc. So that made an enormous difference to her, even just, right from the word go, let alone over the next 10 years. So if she stayed with that same amount of money and got the same interest rate, we're talking nearly £50,000 worth of extra money compared to having left it where it was. So that in itself is not insignificant. That's a pretty, huge difference for that person compared to where she had had it before. So that's just one example, very basic really, very sort of nuts and bolts. So let's go on to another pretty powerful idea. And this idea is the idea of what's called pound cost averaging or dollar cost averaging, or whichever currency you work with in your country. And the idea of this is that you take a certain amount of currency, whether it's, so if I'm going to talk in pounds because I live in the UK. So let's say I decided to take £100 a month and I wanted to put it into a particular long-term investment. Okay, we're talking long-term here. That's the key. And you take that same amount of money and you take the same amount of money every month, each and every month, so £100 each and every month, and you put it into your chosen investment vehicle. Now, it could just be a high rate bank account, high interest rate bank account. It could be a unit trust. It could be a particular stock or share on the stock market. It could be a cryptocurrency. There are several different things that you could put your money into on this basis. And you put the same amount in to the same vehicle each and every month. There are funds, for example, that you can work with to sort of track your money, that track certain things like the FTSE or the NASDAQ, for example, and they track those particular institutions. And you just put your money in at particular times, same time, each and every month. And the idea being with pound cost averaging is that sometimes you'll be buying that particular investment at a high price and sometimes you'll be buying it at a lower price. And what happens is that it averages out over the course of time. So let's just say that, to keep it simple, that I'm going to put my money into a vehicle that will create me 8% a year. Yes, they are out there, and a lot more. And I know that most people achieve less than that, but let's talk at 8%. And we're going to pound cost average £100 a month, every month for the next 20 years. And we're going to achieve an interest rate of 8%. And of course, it's going to compound over the course of time, meaning it's going to continue to go up over the course of time, because you're going to have more of a fund in there. But you're going to benefit from the prices not just going up, but also going down, because when the prices go down of that particular fund, that means when the prices go up again, your money is worth more. You can read about this on the internet. It's a fantastic approach. So after 20 years, you have now yourself put in a total of £24,000. But after the 20 years, it's now worth £58,902. Not too bad. The amazing thing is, if you left it for another 5 years, kept on doing it for just another 5 years, the extra amount is pretty incredible. You could have a total fund of £95,103 just from having consistently kept on putting your £100 per month in over the course of that time. So that would have meant about £30,000 that you'd have put in, now worth £95,000. So you've more than tripled your money. So this is the power of time and consistent, regular payments into some form of vehicle that's going to grow your money. Even at a rate of 5% per annum, it's pretty decent and would equate to £59,551 over 25 years. So even if you think, I'm not sure where to find an interest rate of 8% a year, that's fine. 5%. If you can find 5%, there are index funds that you can get 5% on every year. And if they allow you to do the pound cost averaging, do that. It would equate to nearly £60,000 in total over 25 years. If you can afford more, great. If you can afford to index link, meaning that you increase your contributions by the rate of inflation every year, so you don't just put in your £100 a month, maybe the second year it might be £102 a month, and the third year it might be £105 a month, and so on and so forth. It creeps up gently with the level of inflation so that you're not missing out, and actually your pot will be worth significantly more. So I can tell you an actual example of this. We had set up a child trust fund for our son a couple of years after he was born, and we just decided to have a bit of a play with it, really. We put £50 a month in. We have other bits and pieces going on as well, but we thought for him, let's just do this for him so that he has a pot of cash for himself at the age of 18. And we decided to put £50 a month into this particular child trust fund. We were consistent. It was index linked, so it has gone up consistently every year, and it's basically pound cost averaged. And my husband was very good at finding particular funds within the child trust fund that we could specify, and they were slightly higher risk than your average child trust fund. However, what's happened has really, really paid off. So started at £50 a month. This was index linked at 2.5% per annum. So the payments did increase over the course of time, little bit by little bit every single year. And it was in a higher risk account over the period of 15 years. He's not quite 18, so he's still got about another year's worth of growth. However, the fund is now worth over £27,000. And if it carries on going like this, it's going to be worth over £30,000, possibly even more by the time he actually turns 18, which is not a bad little nest egg for him when he's starting out in his adult life. So it just goes to show the power of being consistent and leaving it alone. And the great thing is that you can set these things up automatically. Once you've made the decision about how much you're going to put in and where you're going to put it in, you just leave the rest alone. So that's that one small decision to go for something like this is really, really powerful. Pound cost averaging is one of the best forms of making your money grow over the long term. And we've had a few similar experiences from buying property. So the first one I can tell you, we decided to buy a property in London. I was a student and my husband was working. He was my boyfriend then, right? We're talking years ago. He was a croupier in London and we were deciding where to live, and we'd been looking around at places to rent. And the rental amount for a one-bedroom flat at the time in the area we were looking was about £450 a month. And we decided, well, okay, we did the numbers and decided, well, if we bought a flat, how much would the mortgage payments be? And the mortgage payments worked out at £220 a month. So we thought, that's not a bad deal. Save half the money we would have spent on rent and actually buy somewhere. So I got a student loan out. We saved some money. We saved probably about £1,200, £1,500, and we were able to put a deposit down, pay all the legal fees, broker fee, valuation fee, etc. And we bought our first flat. We bought that flat for £33,000. I know. You can't even get a part of a parking space now in London for 33,000. We're talking a long time. We're talking back in 1994. And what happened over the next 5 years? So in 1999, that flat had more than doubled in value. We sold it for £67,000. So from just that one decision to buy somewhere instead of renting somewhere that was the stepping stone that we needed to build everything that we have today, basically. If we hadn't done that, we would not be in the position that we are in today. So that was extremely powerful. Another example, property example. We bought our first buy-to-let property in 2001 in a little seaside town on the south of England called Littlehampton. And again, it was a one-bedroom flat. And what we did was we bought the flat with an 85% loan to value mortgage and a student loan. So by this point, my husband had gone back to university and he had managed to get a student loan. And we put the student loan down as a deposit and we bought the flat with a mortgage that I was able to raise from my earnings. So in effect, get this, it was 100% financed. Pretty awesome. Still possible if you're clever and if you know how to do it, but it's more rare these days. It's definitely harder to start off with 100% financing, but that was our experience at that particular time. So we had basically none of our own cash in this property. And we bought the flat for £46,000. And the rent on that flat was about £450 a month. About £250 a month expenses. So we were cash flow positive £200 per month. So let's have a look at what those stats have done for us. That one decision to buy that first buy-to-let flat all those years ago, 2001. This podcast is now going out in 2024. We've owned that property for 23 years. So let's have a look at what's happened over the course of that time. The property is now worth £150,000. So that means we've had £104,000 of capital growth, capital gain over the course of that time. We've also had there or thereabouts £200 a month cash flow. Admittedly, sometimes it's been more like 250, maybe some other times it's been more like 175. But let's call it averaged out at £200 a month cash flow over the course of time, considering the expenses that we've had and the rent that we've had coming in. And we have actually leveraged this property, but if we hadn't, let's just keep it simple. So £200 a month cash flow over 23 years equals £55,200 over that 25 years. So the total value that we have had from this property in terms of the capital growth we've had and the cash flow has been £159,200 from one property that we bought with none of our own money. I don't know about you, but to me this is mind-blowing. This is basically free money that we've had from one decision that we made way back when. Now, of course, there has been work involved to buy the property, to learn how to run it, and to keep it operational. But there's been a huge upside. And remember, this is just one property. We went on to replicate this and build our property portfolio over the last 23 years. They haven't all worked out exactly the same as this. And of course, the holy grail of being able to buy property without any of your own money down or any of your own money left in is extraordinarily rare, but it is possible. And the most important thing is that you learn how to do this, how to actually be creative, how you can leave as little of your own money into a property transaction as you possibly can. There are lots of different ways that you can do this, and perhaps that's a whole other podcast episode for another time. I'm just sharing with you the idea of what is possible, and making that leap of faith. Making one small change in your world could make a huge difference over the course of time. So these are just a few examples of what is possible if you actually commit to making a decision, commit to making that tweak in your finances. It could be the difference between having a mediocre financial future and actually creating yourself a small fortune or a relatively large fortune. So I hope this has inspired you to think, okay, what have I got coming in? What could I do differently? How could I work with my money to make it grow over the longer term and have a huger impact in my future in terms of what's possible and what I'm able to do later on down the line? So have a think about that. What is the one small step that you could take, that you could commit to in terms of tweaking your finances to create this potential fortune down the line for yourself? Once you've set it up, once you've got the idea of this and how straightforward it can be, you can rinse and repeat. You can build up lots of these little tweaks and changes in your finances to really make a difference in your life. And that is exactly what we help people to do within our Freedom Club. We are a group of like-minded, like-hearted individuals who are all on the same journey towards financial and lifestyle freedom. And we love nothing more than supporting and helping and facilitating, nurturing each other in terms of this journey. So if you'd like to know more, click on the link below, and I look forward to seeing you there.